Oh no! Gold has pulled back, even as war risk is rising. And that has a lot of people completely baffled because we've all been taught that gold is a flight to safety asset. So if uncertainty is rising, why is gold falling? Does that mean that the move is over? Or are we looking at the wrong signal? Because while the public is watching the price, Tether has been buying physical gold, 14 tons in just the last 3 months. And Tether is not simply another investor. It has positioned itself almost like a central bank for the emerging digital financial system. You see the rails being put in place? It issues a dollar-linked currency, stablecoin, operates across the new payment rails, and is building the reserves behind that system. So here's the question that sets up everything that I am about to show you. Why are the people helping build and control the new financial rails choosing to hold physical gold? Because they may understand something the daily price chart does not reveal. Over the next few minutes, we're going to look at what is happening in gold, oil, interest rates, and the bond market, the Federal Reserve, and global policy uncertainty. And then we're going to bring it all back to you because that's where it really matters. And the real question is not simply whether gold went up or down today. The real question is, as the system changes, where is the value of your work being stored? If this kind of conversation helps you see the hidden truths of money, subscribe, like, and tell me in the comments what you think Tether's gold buying is really telling us. So let's begin with the signal everyone is watching, the falling gold price, and then we can compare it with the signal the largest buyers appear to be watching instead. This is where the headline gets tricky. Yep, spot gold is pulled back from the January high, but look closer. Year over year, spot gold is still higher. So the question is not simply, why did gold fall? The better question is, what pushed the spot contract so far ahead of itself in the first place? Because flow of funds, we've talked about this many times, that sloshes and it pushes a trading contract into overvaluation, not fair valuation or not the fundamental value. But money rushes in. I'm sorry. See, I'm still learning too. Currency rushes in and traders chase momentum. The spot price moves. But that still does not mean the spot contract is showing you gold's fundamental value. And this is the distinction we keep coming back to. The spot price can tell you where traders are today. But frankly, physical gold tells you what survives when confidence changes and fails. So now we have to ask what those sophisticated buyers may be seeing that the price chart doesn't show. Because oil is moving higher again as Middle East conflict threatens supply, up and down, up and down. And oil is not just oil. We've talked about this recently. It touches food, transportation, energy, production, shipping, fertilizer, everything. So when oil rises, the cost of living rises with it. And this is where Wall Street becomes Main Street because it shows up in groceries, gas, utility bills, business costs, mortgage rates, insurance, and retirement income. Hurts retirement income a lot. So again, I ask, does this system hold the value of my work over time? Or am I working harder just to stand still or fall behind? And the bond market is already starting to react to that. The 2-year Treasury yield has climbed above the Fed's target rate, that 2% inflation, so that you don't change your pattern. But the Fed sets the overnight rate. The bond market prices in confidence. And when the 2-year rises above the Fed's target, the Treasury market may be saying, we don't believe inflation is under control. Not just today's inflation, but the inflation still being created as more and more debt enters a debt-based currency system. That's the hidden truth. The Fed must convince the market, investors must keep accepting the debt, and the currency must keep that confidence. That is a lot of faith required from a system built on promises. And the question is the bond market confidence showing growing cracks? But that concern is not staying just in the short-term rates. The 10-year and the 30-year yields are rising too. The 30-year is the highest since 2007. 2007. And that matters because long-term yields measure long-term confidence. Will that inflation stay contained? It's really about that inflation expectation. Will buyers keep financing the government debt? Will the currency hold that purchasing power? It never does. And this slide does not stay on Wall Street. Higher yields can mean higher borrowing costs, lower bond values, pressure on real estate, on businesses, pressure on retirement accounts. For you, that can mean a higher mortgage, car loan, or credit card rate, falling bond values in your retirement account, and pressure on home prices and jobs. So ask yourself, what do I actually own? Who must perform? Can the rules change? The Fed says the policy is restricted, but financial conditions have already been easy. And guess what? They're even getting easier. That helps explain why inflation remains sticky. The Fed raises the overnight rate while the broader system continues supporting credit, borrowing, asset prices, and demand. So they claim to restrain inflation. While the system keeps feeding the conditions that let inflation survive. And if the bond market loses confidence, yields rise, debt costs climb, and pressure builds to create even more currency. That's when the inflation will accelerate even more. We saw similarly easy conditions leading into 2007. I'm about to show you that. The trigger may be different, but the vulnerability is familiar. Now, look at the chart. Conditions were already easy. They're becoming even easier. And this is the Chicago Fed National Financial Condition Index. Above 0, credit is harder to get. Below 0, credit is easier to get. Look, this chart easily shows financial conditions have been easy almost continuously since 2010. Now they're getting even easier. Easy credit means more borrowing. Easier borrowing means more debt. And when debt and currency expand faster than real goods and services, each currency unit, each dollar buys less and less and less. Duh. So does this look like the Fed is truly fighting inflation, like they claim? Or does it look like the Fed is managing the rate and speed at which the value of our work is lost? That's why the question's not only what will the Fed do? The real question is, who controls the monetary rails? The credit rails, the banking rails, the payment rails, the market rails. And as those rails change, do you still own what you thought that you owned? Now, if this is helping you connect the dots, like this video and comment with the word rails. And now even the Fed's measuring stick, that's being questioned. Clarita, who used to sit on the board at the Fed, is warning that if the Fed changes the inflation measure it prefers without clearly saying what it is targeting, that creates uncertainty. The reality is when things don't look the way the government or the central banks want it to look, they always change how they're going to measure it. That keeps you ignorant. Now, all of this may sound technical, but it's not. The dollar, the Treasury market, and the Federal Reserve policy sit underneath the global financial system. So a change in the formula, the target, or the communication can have unintended consequences far beyond Wall Street. That's the vulnerability. The institution influencing the rate and speed of our purchasing power loss looks like they could be changing that measuring stick while becoming less transparent. We can't control that, but we can reduce our dependence on it, and that means becoming your own central bank with physical gold and physical silver. And community matters because real resilience is local. It's knowing who has food, water, skills, protection, and trust when distant systems do not work as expected. We prepare so uncertainty does not leave us without choices. And now Warsh is considering another change that could give markets and the public even less visibility. Warsh is considering reducing the number of Fed meetings. Well, that may seem small, but it's part of a bigger shift. For years, markets been trained to wait for the Fed, really since 2008. Every word, every hint, every pause, and every conference. But what happens when the Fed speaks less, promises less, and gives less guidance? The markets have to price uncertainty without as much Fed hand-holding. And uncertainty does not remain a market problem, it becomes a household problem. Now let's pull back and look at the larger uncertainty picture, because this is the Global Economic Policy Uncertainty Index. And look at where we are. The Fed may change its preferred inflation measure. Warsh may reduce meetings and communication may become a whole lot less clear. Any one of those may sound technical, but in a debt-based, globally connected system, technical changes can create a ripple effect and global shocks. Those shocks can move through currencies, interest rates, credit, and supply chains until they reach your grocery bill, your business, your savings, and your community. We can't control what the Fed changes next, but we can control how dependent we are on the outcome. That's why sound money is not separate from the mantra. Food, water, energy, security, barterability, wealth preservation, community, and shelter. That is self-sovereignty. We don't prepare because we know exactly the next shock. We prepare so we still have choices when it arrives. As uncertainty rises and the rules become less clear, physical gold demand is moving the other way. Physical gold demand has been building for years. That is the part the spot chart does not show you. The trading price can pull back while physical demand remains strong and rises. And that's why I separate paper price from physical ownership. Because exposure is not ownership, and a claim is not the asset. And permission, that's not possession. So ask yourself, what do I actually own? Who must perform? And can those rules change? because physical gold does not need a bank to perform. It does not need a government promise to be gold. And the biggest confirmation is who else is buying it. Because central bank buying rebounded sharply in Q2. But guess what? It's never really fallen down since 2005. So ask yourself, are central banks buying gold because they think each day will be a good trade and it's going to be an up day? Of course not. They're buying because they understand what they're doing to the system, and they understand what happens when confidence in debt, policy, and currencies weakens. That is the hidden truth. Gold is pulling back in trading price, but the reason for owning it, that's not gone away. If anything, that reason is getting clearer and bigger. So to continue the conversation and carry this discovery to someone you love and ask the question, if the institutions building the new financial rails are buying physical gold hand over fist, while the institutions managing the old system are changing the measurements, easing financial conditions to create even more inflation, and asking us to keep trusting them, where do you want the value of your life's work when that trust is finally tested? Inside their promises, or in a foundation you own, you control, and can carry forward with your family and your local community? And if you want help building your foundation, sit down with one of our strategy specialists and look at where you're strong and where you're exposed. And we can show you how physical gold and physical silver can fit into a broader sound money strategy. And please, please participate in the sound money movement. All you have to do is convert your garbage fiat into sound money, physical gold and silver. We're working towards something way bigger than just a portfolio. We're working toward redeemable gold in the global monetary system. And all you really have to do is talk about it and participate. So honest money can once again carry honest labor, your labor. And until we meet, wherever you are in the world, please be safe out there. Bye-bye.